Welcome back to another video where we're talking about even more ratios. Now, ratios is a very important topic in financial management, in CFA, in CMA, regardless of what you study. Ratios are the heart and soul of financial statements, right? If you want to interpret, analyze financial statements, ratios are how you do it. So we want to talk about two key ratios, degree of operating leverage and degree of financial leverage in this video specifically. So what do we mean by operating leverage? And then obviously we'll talk about the ratio. So operating leverage is essentially when you run a business with a high proportion of fixed costs rather than variable costs. Now you might ask, why do companies do this, right? This is particularly prevalent, right? High operating leverage in capital intensive industries. So airlines is definitely one where they prefer having a lot of operating leverage, where a huge proportion of their cost is fixed in nature and then some of it is variable, or rather a less portion is variable. Now, if you look at any sort of labor intensive, unit, they will have a low degree of operating leverage as compared to a capital intensive unit. Now, with that being said, there are a few flaws to being a company that is high on operating leverage. One of them is that you need to keep your sales up to ensure that you're even recovering your fixed costs. The minute your sales drop, it is a very dangerous sign, because then you're not going to be able to even cover your fixed costs, right? So that is definitely something that you need to keep in mind if you're going with a high degree of operating leverage. Why do companies do it? Well, the risks are huge, but the returns are even greater. And it is all about chasing risks and then getting returns for it, or rather very handsome returns for it. Now, what happens with operating leverage? After your fixed costs have been covered by obviously your revenue, then you retain most of it in your earnings before interest and tax, right? Once your fixed costs are covered, you're good to go. You're making more money in a lot of ways, right? If variable costs are low, you are not incurring more costs with production or with services. So that definitely makes sense. Now, we look at the formula for operating leverage very quickly. Operating leverage is basically the percentage change in earnings before interest and tax divided by percentage change in sales. There's also another way to compute this. It is simply contribution margin divided by earnings before interest and tax. So that is essentially operating leverage.